Hi guys, I hope you all are doing well. So welcome to the session today. We are going to start off the third day of this financial management revision session. Up till now, we have gone through the working capital management and we have also gone through the cost of capital. Our agenda for today is going to be the investment appraisal. So we're going to do two sessions on investment appraisal and then we would move on to the other areas which include the risk management and the sources of finance. So we're going to and the business valuations. So I would try to actually cover up the maximum what I can in today's session, and then we're going to take things forward. So as usual, I'm going to start off with the past examination papers. And amongst the past examination papers, no, Alina, we could not do it yesterday. I was not available. Okay. Okay, now let's see. So if I talk about this financial management past examination paper, let's just see that what exactly are the different questions all about. So I'll start off with the March-June 2021. There is a past paper question in which they have actually tested the investment appraisal. So what we would do is that we would try to get through this specific paper and we'll try to see that how things are. So basically, um, there is a question which is question number, I think, 4 onwards. Okay, now there is this question number 4, and this question number 4 is about the Cabrera's company. Cabrera's company is what the question is. Now we would see that what exactly are the topics that are part and parcel of this question. So one of them is called the topic of equivalent annual cost. What is it? It's an equivalent annual cost of the 3 and 4 year replacement cycles for the Beast and advise Cabrera's company which replacement interval to adopt. That's one thing. If we move a bit forward and if we discuss further, it says why replacement interval decision should be based upon equivalent annual cost. Then you've got the third requirement of the question, which is basically discuss why discounted cash flows of investment appraisal are considered superior to non-discounted cash flow methods. So this is how you will have these 20 marks requirement. Now what we are going to do is that we are going to try and discuss that about these things and we're going to take things forward. So basically, with respect to the investment appraisal, there's a syllabus area, the name of which is called asset replacement cycle. There's a syllabus area, the name of which is called asset replacement cycle. What do we mean by this asset replacement cycle? So when we talk about the asset replacement cycle, so at times the companies, they have got multiple type of assets and those assets are regularly used in the business. So if you have got multiple types of assets and if those assets are regularly used in the business, so you might actually have to continuously replace the assets. Like you might have to continuously replace machinery, equipments, etc., etc. You might have to do that. Yes, you can move on to the next question without doing the current one. Yes. So basically what happens is that the concept of asset replacement cycle is that whether we should continue to replace our asset in 2 years time, 3 years time, 4 year time, 5 year time, etc., etc., etc. What should be the replacement cycle? I repeat, what should be the replacement cycle? So basically, when we talk about the concept of the asset replacement cycle, let me just guide you a bit. That basically the concept of asset replacement cycle is that you have to decide that what is going to be the replacement cycle that is going to be most feasible for the entity. So how do we do it? So what we simply do is that we actually calculate something which is called equivalent annual cost. What exactly do you mean by equivalent annual cost? The equivalent annual cost is the present value of the cash flows divided by annuity factor. So let's say, for example, what are the cash flows that are associated with the ownership of the asset? Try to understand few things. When you own an asset, so the cost of purchasing the asset is a relevant cash flow. The maintenance cost is a relevant cash flow. Disposal proceeds, or we call the scrap value, that's a relevant cash flow. So you've got the cost, the maintenance, the disposal proceeds of the scrap, they're all gonna be considered as what? Relevant cash flow. Even the depreciation, the tax savings on depreciation, etc., etc., they're all gonna be considered as your relevant cash flows. What is it gonna be considered as? They're all gonna be considered as your relevant cash flows. So now when we talk about the concept of these cash flows, there's something that I want you to understand is that we try to calculate the present value of all the cash flows which are associated with the different replacement cycle. And once we have the cash flows, what we do is that we use this cash flows and we try to calculate the equivalent annual cost, which is also called EAC. So like every replacement cycle, 2 year, 3 year, 4 year, 5 year, we calculate we calculate the equivalent annual cost of them. What we do is that we calculate the equivalent annual cost for them, right? Is that okay? Now, let's try to do this question and let's try to apply the concept of equivalent annual cost in this scenario. So basically it says Cabrera's is a construction company. It uses a large earth moving vehicle called the Beast to prepare foundations for the buildings. What does it want to do? It wants to prepare foundations for the buildings. It needs to decide whether the cheapest replacement interval for the Beast is 3 or 4 years. So they have to decide between the 3 year replacement cycle and between 4 year replacement cycle. You have to decide between 3 year replacement cycle and you have to decide between the 4 year replacement cycle. Now what next is there? The following details are available. It says Cabrera's company purchases the beast from a manufacturer for $800,000. So this is the cost. Payable after 1 year of delivery. Payable after 1 year of delivery. Its resale value will fall by 40% of the purchase price at the end of first year of operation. Resale value will then reduce by 25% of its previous resale value for each further year of operation. Yearly maintenance cost of this. So we know that what are the relevant cash flows over here. One of them is the cost of asset, the residual value, maintenance cost, fuel cost. If the beast is operated beyond 3 years, it is subject to government safety and carbon emission test. The test would be paid for and would take place at the beginning of the 4th year of operations. Correction of any faults by this test is mandatory. There is an 80% chance that the test and remedial work will cost. Test and remedial work will cost 550,000 and a 20% chance it will cost this. The cost of capital is 8%. No, not at all. Not at all. It does not. Because ACCA allows you to do the self-study. You don't have to worry about it. 3 year replacement cycle, 4 year replacement cycle. Now just try to understand this thing. So basically, what happens is this is time period 0, 1, 2, 3, 4. There is no mention of tax in here. So I'm just going to be ignoring the depreciation. The cost of the asset is 800,000 because it is payable after 1 year of operation. What is happening is it is payable after 1 year of operations. The residual value is gonna be what? Is gonna be 40% at the end of first year of operation, and it will reduce by 25% of its resale value at the end of this. Now, so residual value is gonna be 800,000 multiplied by 0.6. Why? Because it is 40%. It will fall by 40% of the purchase price, and then it will reduce by 25%. So multiply by 0.75, multiply by 0.75. Now you would say, why have I done this? Do you understand this? Do you understand why have I done this? Okay, now see, 800,000 is the cost of asset. Its residual value will fall by 40%. So when it falls by 40%, that means it becomes 60%. And then it falls further 25% each year. So it will become 75% of the remaining value and then 75%. So that's why I've done it this way. Then you've got the maintenance cost 20,000 at the end of its first year of operations. 20,000. Rising by 5% each year, maintenance must be provided in the sale of year of sale into 1.05. Yes, so we are doing in third year, but we are going to be selling at the end of third year of operation. So we are like at the end of first year of operation, it becomes 60%. Then at the end of second year of operation, it becomes 75% of the 60%. And at the third year of operation, it becomes the 75% of the year two value. See, what have I done? Okay, see what happens is that, but what is the end of the first year? What do you mean to ask? I mean, are you confused with the residual value or what, Saleh? Where are you stuck? Okay, let me just guide you through the resale value by doing it a bit more in a better manner. See, uh, I think I did it directly. That's why you're confused. The cost is 800,000. The year one, it is gonna become this into 60%. Year two, this will become year two. This will become just a second. This will become uh, 75% of this. Hold on a second, please. Okay, so see, what happens is that Saleha, this is how we have actually been able to calculate 270,000. Just a second, please. 270,000 is how we have actually calculated.
Assalamualaikum, sir.
Ji, walaikum salam.
Sir, actually, I was confusing resale value with reducing balance method. Now I understand what it is.
Okay, lovely. Okay,
Thank you,
can you
sir.
people just do this fuel cost and all that? Can you do the fuel cost and all that? Okay. Now, what is the fuel cost? It says fuel cost would be 28,000 in the first year, rising by 5,000 each year. 28,000. Then this is this. Sorry. Then it is rising by 5,000. Remedial work is going to be zero. Total cost. The present, okay, discount factor, and then the present value. So basically what happens is that this is gonna be the sum of all this. Then this is gonna be the sum of all this. So what would happen is that you would calculate the present value on this basis. So you see, what have we done? We have actually been able to establish these are the values here 0, 1, 2, 3. Cost of the asset is given, and then the residual value is given, so and so, so and so. So here we go. Okay. The present value of the cash flows of all of this turns out to be how much? The present value of the cash flows turns out to be this. We need to have the annuity factor for the 3 year. What is the discount rate? It's 8%, right? Discount factor is 8%. Now, what have I done? I've actually used 8% power minus 1, 2, 3. So the annuity factor, there are multiple formula also, but you could just do it like this also. So the equivalent annual cost will be this divided by this, which is 257971. So your equivalent annual cost is gonna be 257971. Now, do you understand this? Yeah, do you understand this, please? Do let me know if you understand this, please. Okay, now I will just do this. I will just copy all of this and I would actually create a Fourier replacement cycle. So in order to create the Fourier replacement cycle, this residual value is going to change. The residual value is going to change a bit. What would happen to the residual value? We'll just copy this. In fact, cut it from here. And this is again going to be multiplied by 0.75. And what is actually going to happen is that everything else will be the same way it is going to be there. And then we have got the test and the remedial work. There's a 80% chance that the test and remedial work will cause this, 20% chance it will cause this. So now I talk about the test and remedial work. What do I need to calculate? I need to calculate the expected value. Expected value. How do we calculate the expected value? 20% chance. It is 50,000. There's a, sorry, 80% chance it is 50,000. There's a 20% chance this is 120,000. So hence resultingly this into this. So test and remedial work would cost you what? 64,000. And it would take place at the beginning of year 4. So hence resultingly, what would happen is this is what it is going to be. Okay, so the equivalent annual cost here is gonna be 250. The equivalent annual cost here is gonna be 250,515. So it says calculate equivalent annual cost of 3-year and 4-year and advise which replacement interval to adopt. So see, the replacement interval with the lowest cost is to be adapted. The 4-year replacement interval has a lower cost as compared to 3-year replacement interval. So this is where the difference lies. I repeat, this is where the difference lies. Right? Is that okay? So this is what the answer is going to be. Now let me know if any one of you has got any queries till now. There is no tax mentioned in this question. There is no tax mentioned in this question. Okay, actually, I just switched phone, so I don't know something wrong with this WhatsApp thing or that. I'm not getting the code. I'm not able to start off my phone actually. So just trying to get it fixed. We'll respond back. Yes, we will incorporate the tax expense also. Okay, what's the next question? Let's just see. The next question is, it says discuss why replacement interval decisions should be based upon equivalent annual cost. Now let me just guide you about it. Let me just explain to you the reason that why it should be based on the replacement interval decision. Okay. Um, Comparison should always, I'm just writing down pointer, should always be like with like. A 3-year expense cannot be compared with 4-year expenses. They need to be brought at par with each other due to incorporation of time value of money. The total cash flows are in present value terms. Due to incorporation of time value of money, the total cash flows are in present value terms. So due to incorporation of the time value of money, the total cash flows are in present value terms. The total outflows cannot be divided by the number of years because the outflows are established in terms of present value. Therefore, EAC is used, which compares present value of outflows with the annuity factor. Result is it gives annual expenditure incorporating the present value terms and bringing the expenditures at par with each other. I've just mentioned few pointers and you could just elaborate this. Now, last question is basically why discounted cash flow methods are considered superior to non-discounted cash flow methods. So, what happens is that the money loses its value over time. There is a effect of time value of money. The investments made and recovered over time should incorporate the effect of time value of money. If there are idle cash flows available, such cash flows can provide benefits for the longer run. To be able to yeah, they can ask any question. To be able to have a better evaluation, it's always important to consider the effect of time value of money. All the discounted cash flow based techniques incorporate this effect and hence are superior and hence are superior. Depends upon if you can write 5 points, 5 points. If not, because if there could be a scenario where there's a discussion and things like that, so what happens is that only 2 3 points are sufficient, but they have to be elaborated. Only 2 3 points are sufficient, but they have to be elaborated. uh, it at times repeated, at times they give new questions. Right? Okay, so we are done with this specific question. I'm going ahead and I'm going to start off the September December 2021 question number 4. Okay, what is the examiner? This question, Hawker company, it says Hawker is about to replace its existing delivery vehicles. Hawker is about to replace its existing delivery vehicles with a new design of vehicle that offers greater fuel economy. It estimates that to replacing the existing vehicle will save running cost of 2000 per year. There are two financing options. Requirement is evaluate whether hawker should use leasing or borrowing as a source of finance. What's the next one? Discuss two reasons why hawker may choose to lease rather than buy the new delivery vehicles, 4 marks. Then third one of them is discuss three advantages of using NPV rather than IRR in investment appraisal. So this is what they have actually done in here. Now let's just start off and let's just start to see which is idle cash flow. Okay, idle cash flow is like if your cash flow is idle means if it is not invested, it is losing money. So what happens is that you have the cash. What you do is that you invest that cash into the bank to make more money out of it. To make more money out of it. Now here in this situation, what is happening is that we have to decide whether to lease or borrow as a source of finance. Okay, see what happens is that, for example, I've got money and I've deposited that money into the bank. That money will give me returns. And if I don't invest in bank and if I rather invest in a project, so I need to earn money out of the project. Otherwise, I have a opportunity cost involved. Otherwise, I have an opportunity cost involved. Now, can you just go through this option number one and option number two? Then I'll guide you through that how to do these. Can you go through option one and option two? Okay, now let's see. It says the vehicle could be purchased for $34,000 using a bank loan. Okay, it is estimated that replacing the existing vehicle will save running cost of 2,000 per year. Vehicle would be purchased for $34,000 using a bank loan with an after-tax borrowing cost of 4% per year. The vehicle could have a useful life of 4 years and would have a residual value of 14,000 at the end of the period. A straight line allowable depreciation is available on the vehicle. Vehicle would be subject to CO2 tax of 600 at the end of each year of operation. Emission tax expenses are deductible. Option 2, vehicle would be leased for 4 years for a payment of this, payable at the start of each year. Lessor will pay the CO2 tax. Lease payments are a corporation tax deductible. After tax weighted average cost of capital is 8%. The tax is 20% payable in arrears. Okay. Let's just try to do the option number 1, which is the bank loan. Option number 1, which is actually gonna be the bank loan. You've got 0, 1, 2, 3, 4. What's the life of the asset? 4 years. And 5 also. Depreciation is gonna be 34,000 minus 14,000 divided by 4. So I've got here 1, 2, 3, 4. CO2 tax 600, 600, 600. So you'll have the CO2 tax. Then what happens is that the tax deductible amount is gonna be this, is gonna be this. Tax deduction at 20%. Tax deduction at 20% is gonna be this into 20%. Depreciation needs to be added back because it's a non-cash item. Hence, what happens is that cash flows would be established like this. The cash flows are gonna be what? 4% discount factor. Present value is gonna be total cost will be sum of all this, which is basically 32 to 68. The total cost would be 32 to 68. Right? Okay. Can you just look at it and can you just confirm if you understand this? I'm just slightly zooming it in so that you could see. This was option number one, the bank loan. This was option number one, the bank loan. Right? Is there any question on this, please? Is there any question on this, please? No, the tax saving is calculated on both the depreciation and also on this carbon emissions. But it is 1 year in arrears. It is 1 year in arrears. Okay, now let's move a bit forward and let's talk about the option number two. It says vehicle could be leased for a period of 4 years. Okay, cash flow of 600 is very simple. I have not done any calculation. I've simply used this. That's it. This is 600 mentioned here. I've simply applied it. Okay. The cash flows in the bold is like this: tax deductible amount, and then the tax savings, and then the depreciation which is added back. Now I'll just move on to option number 2. I'll move on to option number 2. So I will go on to the option number 2. It says the vehicle could be leased for a period of 4 years for a payment of $6,000 per year, payable at the start of each year. 0, 1, 2, 3, 4, 5. Payable at the start of each year, the lessor will pay the carbon. Okay. Rental 6,000, 6,000, 6,000, 6,000, and 6,000. Then what actually happens? The next thing is that you need to understand what happens next. Okay, so what do we have? We have got the carbon dioxide emission, which is 600 here. So you got to pay for this. Then cash flows. Then you incorporate tax savings at 20%. Then what actually happens is that net cash flow is this plus this plus this. The discount factor at the rate of 8% is like this. The present value of the cash flow is going to be this into this. Total cost will be the sum of all this. Gives you 19107. Okay, Zolani, they are being posted on the they're being posted on the YouTube channel also, and plus they are also available on the web portal also. Yeah, but lessee will actually have these expenses as tax deductible, na? These expenses would be tax deductible for lessee. Okay. Where did we pay 600? See, we are paying 6,000 plus 600, both, na? Okay, see, let me just guide you something. Let's say, for example, if I tell you that this is year one, this is year two, this is year three. This is profit before depreciation. 200,000, 300,000, 400,000. This is depreciation. 30,000, 30,000, 30,000. The profit before tax is gonna be 170,000, 270,000, 370,000. Now what happens is that you charge tax at the rate of 10%. 17,000, 27,000, 37,000. Then what you do is that you add back the depreciation to it. 30,000, 30,000, 30,000. So what happens is that there's actually gonna be a cash flows. How much is that cash flow gonna be? 183,000. 273,000. 363,000. Now that's one way of doing the calculations. Now let me just guide you another way of doing the calculations. Another way of doing the calculation is that you could simply say this is option one or method one. Option two or method two is going to be what? Year one, year two, year three. So profit before tax is 200,000, 300,000, 400,000. Now what happens is that you apply tax directly on it at the rate of 10%, gives you 20,000, 30,000, 40,000. Then what you have to do is that you have to say tax savings due to depreciation. So the depreciation each year was 30,000, right? 3,000, 3,000, 3,000. And the cash flows are gonna be like this. 183, 273, 363,000.
Thank you, sir. Sir, but my question is that 600 tax that the company is paying to the government. But still we are adding this in tax deductible.
Can you just repeat, please?
That the 600 rupees tax the company itself paying to the government.
Yes.
Then why we are adding this in the tax deductible?
Why are we adding it into the tax deductible? Okay. Wait, let me just switch my headphones because my headphone has actually just its battery has just died. So let me just switch the headphone first. Wait a ओके, आई एम सॉरी साले, आप जरा प्लीज बताएं क्या प्रॉब्लम हो रहा है आपको, जरा मुझे समझा दें ताकि मैं आपको जो ना उसके अकॉर्डिंगली गाइड कर दूं।
सर मुझे ये मसला आ रहा है कि हम टैक्स एक कंपनी जो है वो टैक्स पे करिए गवर्नमेंट को, खुद
हम्म।
पे करिए 600। तो वो जो
हम्म।
टैक्स है वो क्यों नहीं वो हम टैक्स डिडक्टेबल के तौर पे क्यों उसको देख रहे हैं,
अच्छा सही है, मैं
जबकि वो तो
समझाता
हमने
हूँ, सॉरी।
ऑलरेडी।
मैं समझ
जी
गया, मैं समझ गया आपको क्या प्रॉब्लम हो रहा है, सही है।
जी सर।
वो वर्ड जो टैक्स का है ना, वो टैक्स का वर्ड आपको प्रॉब्लम कर रहा है, मुझे एक्सप्लेन करने दें, मैं आपको समझाता हूँ। सी, what happens is that you are mixing it up with the word taxation because you think that how can I claim tax deduction on the tax that I paid. That's what your problem is. So let me just guide
यस
you
सर।
that, see, what happens is that there are different type of taxes like income taxes, sales taxes, property taxes, etc., etc. There are so many different type of taxes. So what actually happens is that the tax authorities, while calculating the income tax, may actually allow you to claim some of the taxes that you have paid as an expense. So here what you have to consider is that it's just that, let's say you are paying carbon dioxide emission fee. Let's say it's not carbon dioxide emission tax. You say it's a carbon dioxide emission fee. So when I will call it fee, then the problem in your mind would actually not remain anymore. Right? You get my point? Okay, lovely. Now let's move a bit forward and let's discuss further. If you practice the recent exam question, that is good enough. Plus, from the exam kit, you could do the MCQs. From the exam kit, you could do the MCQs. No, not necessary. Now it says evaluate whether they should go for leasing or borrowing as a source of finance. So what would you do? You would say that the leasing is a cheaper option for the financing. So leasing is a cheaper option for the financing, right? That's what you would go for. You would go for leasing as an option. Now, if I go a bit forward and if I talk about the further questions, it says discuss two reasons other than possible tax advantages, which hawker may choose to lease rather than buy the new delivery vehicle. Now, what could be the reasons? Leasing is a flexible option as the asset could be returned earlier also in case if the project does not continue for the longer run. That's one thing. The second thing is that leasing does not require a large initial payment and hence can be undertaken without obtaining borrowing from the banks. So this is actually going to be one of the benefits of leasing, that you could just undertake without taking the money from the bank. Right? Okay. Now what next is there? The next part of the questions requirement is that discuss three advantages of using NPV rather than an IRR in investment appraisal. So what are the advantages? NPV is an absolute measure providing the actual value generated from undertaking the project. The NPV IRR is affected by the size of investment that a smaller investment project may give a higher IRR as compared to larger investment project. Although the cash flows from the larger investment project may be higher. IRR leads to multiple results when the cash flows are IRR leads to multiple results when the cash flows are non-conventional. That is, when cash flows are such that there are outflows during the life of the project too. Whereas with NPV, there is always a single decision, that is whether to invest or not, and no ambiguities involved. So you got to talk about the advantages of this. Is that okay now? Yeah, is that okay now? Yes, Alina, it has been uploaded on the YouTube channel of myself. You could watch it from there, or you could watch it from the Scribers portal also. So it is available on both of them. It's simply Luqman Rafiq. Just search me, Luqman Rafiq. I think I'll ask the team to share it in the WhatsApp group also. Okay. So we are done with this question also. So we have done two questions. That was basically one of the question from March, June 21. There was one question from the September, December 2021. I would try to move on to another question, which is March, June 2022. Yeah, sure. I'll just ask my team to actually add all of you to the WhatsApp group. Okay. I'll take a short break of 5 minutes and then we are going to start off. So we will meet again in 5 minutes time and then we're going to resume. So let's just start off with the next question. And the next question is actually going to be what? It is going to be this Malplash company, which is basically manufacturing the motor vehicles, etc., etc. There are multiple requirements. That is to calculate NPV, IRR, payback. Okay, can you just go through this, please? Okay, let's just start off. It says Malplash company manufactures motorcycles and is considering an investment in new high performance model. The market for high performance motorcycle is very competitive and Malplash directors want to recover the cost of investments of the model quickly before it is made obsolete by more advanced models at the end of 4 years. The directors also wish to show shareholders that the investment will be profitable. Directors have therefore set a target payback period of 2 years. So what's the target payback? It's 2 years. And a target return on capital employed of 20% for the investment. Then it says the directors have also asked the finance director to provide NPV and IRR. They plan to consider results of these calculations if the investment fulfills the target for payback and return on capital employed. Melplash has prepared the following forecast of production and sales for the new model. So there are these year 1, 2, 3, 4, 5. The finance director has prepared the following information. Initial investment, residual value at the end of 4 years, selling price year one price terms, expected selling price inflation, expected variable cost inflation, expected fixed cost inflation, ignore taxation. That's they have made things very easy for us by ignoring the taxation in here. Now, what do we need to do? We need to do the calculations for the net present value and then the IRR and so on and so forth. So basically what happens is that when I talk about the net present value, how do things go about with the net present value? So you have got time period 0, 1, 2, 3, and 4. Selling price, variable cost, contribution per unit, the contribution, fixed cost, investment, and then there is this cash flows. Now, if I talk about this, what actually happens is that the selling price is 20,000 per motorcycle. This selling price is expected to increase by 6%. It is expected to increase by 6%. Variable cost is 14,000. The contribution per unit is gonna be the sum of these two. And then what happens is that we have the number of units. $25,000, $45,000, $40,000, $20,000. The contribution is gonna be this into this, so on and so forth. So this is actually how it is going to be. Now, when we talk about the fixed cost, in fact, what I can do is that I could just convert this all into million also. Divided by 1 into 10 raised to power 6. I could just convert this into million also. The fixed cost is expected to be 120 million per year. And this is expected to increase by 10%. The investment is gonna be 220 million. Residual value is 30 million. The cash flows are going to be these. And then what happens is that he requires us to calculate the net present value, right? So with the net present value function, you would simply say NPV bracket open 0.14 the rate, comma, all the cash flows, and then plus this investment. So you get 19.286. That's the net present value. If we talk about the internal rate of return, it's simply IRR. Okay. Here, cash flows 0, 1, 2, 3, 4. It is gonna be this. It is gonna be this. It is gonna be this, this, and then this. So if you need to calculate the IRR, bracket open, 18.36% is what the IRR is. 18.36% is what the IRR is. Then what we have is we have the payback period. We have the payback period. It's a year. Cash flow, cumulative cash flow. So again, what happens is that so if you could see, this is the time period when we are converting this cumulative cash flow into the positive cash flow. So if you have to calculate the payback period, how would you do it? You would do it like this. The payback period will be 2 years plus 35.58 divided by this. So equals to 2 plus this. 2.23176. Right? So this is what the payback period is. I mean, this is what the payback period is. Right? Now, what is the last area, which is return on capital employed based on average investment? So how would you calculate the accounting rate of return? For the accounting rate of return, you need average annual profit. How would we have the average annual profit? It is simply gonna be It is simply gonna be the sum of this here 0, 1, 2, 3, 4 divided by 4. So this is the average annual profit. There's this average investment, which is simply gonna be opening plus closing divided by 2. So ARR is gonna be, it's like quite high, 79.23%, 79.2%. Now, what is the examiner's requirement for the proposed? Calculate the following. So we have calculated NPV, we have calculated IRR, payback, and the return on capital employed. If I could just try to put these onto the scratch pad, the reason being that he is not asking for any suggestion in here. That means he's probably going to be asking in the next window. NPV, IRR, payback, ARR. So now talk about the NPV. NPV is gonna be what? 19.28. What is the IRR going to be? IRR is 18.36%. The payback is 2.23 years, and ARR is 79% something, 79.2%. Now let's just try to see things, that how exactly are we going to answer the questions remaining parts. Discuss the suitability of the techniques used in A for determining whether to undertake an investment and so and so, so and so. Okay. Okay, based on the results obtained from the calculations performed for the different techniques, the net present value all the techniques suggest that the investment be made except for the payback period technique. The net present value is $19.28 million, which is 19.28, which is a positive NPV, and suggests, which is a positive NPV and suggests Okay, so which suggests that the investment should be made. The internal rate of return is 18.36%, which is higher than the weighted average cost of capital of the entity, and would also recommend that the investment be made. Here you could talk about the advantages of NPV also, that NPV, you can just list down NPV's advantage also over here, one or two. One or two advantages here just to enhance this. This result is in line with the result given by the NPV calculation, which also suggests that the investment be made. Payback period is 2.23 years, which is in excess, which is longer than the desired payback of of 2 years, and hence does not recommend investment. Payback period ignores the cash flows generated beyond payback and is not a suitable method for decision making. The accounting rate of return is 79.2%, which is much higher than the desired result of 20%, which is much higher than the desired result of this much. How much? Of 20%. But the technique is based on the cash flows, which ignores the effect of time value of money, which ignores the concept of time value of money. The overall conclusion is that the investment should be made. Do you get it now? Yeah, do you get it now? right? Okay. So we are done with this question now, and we are done with the different questions on the investment appraisal. And I hope that you people actually just enjoyed the session and that it was a good revision of the investment appraisal. So what we are going to do is that we're going to keep it till here for today, and we're going to continue inshallah in the next session, which is going to be tomorrow, and we will take things forward.